Hello everyone, welcome back to the channel. I'm your host, and today we are diving deep into a global icon that everyone knows, but not everyone is analyzing correctly right now. McDonald's. The ticker is MCD. Well, we just got our hands on a fresh, heavy-hitting report from UBS titled McDonald's Risk Reward Attractive on Pullback with Brand Well Positioned Globally. Now, if you have been watching the market lately, you know the golden arches have been under a bit of pressure and the stock has taken a breather. Well, let's take a look at the chart of McDonald's. Here we go. Can you see that? Yeah, as we said just now, McDonald's has has a pressure. Can you see that? An obvious downward trend, right? From the historical high to here, it is really a big pullback. And now it seems that technically, it seems that here is a support, right? And the RSI is almost hit the oversold zone. Well, let's come back to the report. Let's come back to the report fundamentally. So, this downward trend, is this a supersized problem or just a temporary happy meal headache? Let's break down this several minutes deep dive in the true old power style. Okay, part 1, the short-term stomachache. Let's see. First, let's look at the now. UBS is being very honest here. They expect McDonald's first quarter earnings to be a bit soggy compared to what the street wants. We can read the number. They are predicting US same-store sales, triple S here, at around 3.5%, which is actually below the market consensus for 4%. Alright, why the slowdown? Well, remember that massive winter storm firm, FERN firm, that wiped about 100 basic points of the growth right at the start of the year. And then there are some macro pressures too. It is not just the weather. Higher gas prices and the pressured consumer sentiment mean your average Joe is thinking twice before grabbing that extra McFlurry. Alright, from the global view, international markets are a mixed bag. We have got tough macro backdrops in Europe and the potential impacts from the Middle East conflicts affecting sentiment globally. Investors are feeling a bit negative right now, but as we always say, buy when there's blood or maybe ketchup in the street. Well, we can read from the report here. Let's see how to get down. Now here. Potential impact from the Middle East conflict in Europe and globally, right? This is from the global view. There are some macro pressures. As consumption sector, as one of the consumption sector, McDonald's always play a defensive role. Here, the defensive characters that should provide earnings stability in a still volatile environment. So, everybody can feel that the tech sector has risen a lot in a month, right? So when the tech gonna correct, gonna have a pullback, the defensive sector like consumption, McDonald's probably play a key important important role, right? Because it provides stability. Okay, so why the all-powerful strategy still works? Even though the short term looks a bit gray, UBS is still shouting buy with a 12-month price target of 365. Let's see here, right? UBS give a brand new 12-month rating buy, and the price target is 365. That's a significant upside from the current price of around 286. Why? Because McDonald's playing the long game with some very smart value plays. Well, let's take a look at the data, the financials. Here we go. Yeah, let's talk about money. This is the meat of the burger. Because at the end of the day, the spreadsheets don't lie. McDonald's is a cash flow machine. And we can see the steady growth in revenue. UBS forecasts revenue to climb from about 25.4 billion in 2023 to over 28.7 billion by the end of 2026. So what about the earning power? The earnings per share (EPS) is expected to grow from less than 12 per share to over $13 per share in the same period. And what about the dividends? For all my income investors out there, the dividend isn't going anywhere. It is projected to hit 7.5 per share in 2026, giving you a nice 2.6% yield while you wait for the shock to pop. And the total return, let's take a look. Here we go. Between the price target and the dividends, UBS is looking at the 30% total forecast return. That beats the market assumption of less than 9% by a mile. Wow, what a potential return. Okay, last but not the least, let's talk about the risk. No investment is a total free lunch, right? We have to be professional and look at the risk mentioned in the report. Macro headwinds. If gas prices stay high or employment take up, here, rising unemployment, high gas price, right? The discretionary part of fast food, that extra side of nuggets, get hit first. And the foreign exchange, because they are a global empire, McDonald's everywhere, right? It is a super strong, when there is a super strong US dollar, the exchange rate can eat into the profits they make in euro or yen, right? As everybody knows, the conflicts between Iran and the US, right? Which make the oil price higher. And the oil price, the higher oil price implies higher inflation. And the higher inflation probably force the Fed to raise the rate, and which means that the dollars, the US dollars, will get stronger. And the stronger US dollar means weak foreign exchange rate, right? Like weak euro, weak yen. As we know, McDonald's is everywhere, right? When they earn money in euro or yen or Australian dollars, the foreign exchange rate get weak, they earn less. Okay, this is our analysis about McDonald's. So what do you think? Are you loving McDonald's at the current price, or are you waiting for a value meal price even lower? Let me know in the comments below. Okay, don't forget to like, subscribe, and hit that bell for more institutional research breakdowns. Okay, see you then.